Welcome back to Market Call. Oh, here we go. Top pick, BCE. We've talked about it a lot already. It is the parent company of BNN Bloomberg. Just remind us why you like it.
Well, first of all, I think we're in a tough environment. And what I really want are big dividends. I want to get paid to wait. I want a stable business. I really want to win by playing defense here. I think this stock you mentioned is, at a 52-week low now. I'm not sure if that's for sure, but it's definitely come down. And, wireless is performing very well. Record low churn. Roaming is back to 98% pre-pandemic. The media has been strong. The 12-year journey building out fiber is more than 50% complete, which is very capital intensive. There's a potential inflection there for investors. They're the most advanced of the big three. And I think that they're on the precipice of becoming an infrastructure-like cash generator. That is lifelong assets with much lower CapEx. So if that's the case, I think that you're really looking at some potential multiple expansion here and having a dividend that is closer to 4%. So I think you get paid really nicely to wait for this thesis to play out.
Actually, the yield pretty close to 6% on BCE right now, Greg.
Right.
Sure enough, about 5.9%. And sure enough, 52-week low hit today, $61.14. It is the parent, though, of BNN Bloomberg through its ownership of Bell Media. TC Energy, pipeline giant, you like another dividend play?
Same sort of theme. This name's being a little bit ignored. I think the theme in this tough market here, pipeline is a good place to be. Natural gas, tailwinds, really defensive, good place to be. They just came to market to fund a new purchase, a southeast gateway, which in time will be accretive for them. They got lots of projects for growth. I think robust natural gas prices are a tailwind. They got this nice dividend with 4% dividend growth. And it's got a decent growth profile, the best that I've seen it in a while, at about 5%, and it's trading at an undemanding 15 times. So for the quality of the name, I think it's at a decent price right now. And I think in this environment, you want in your portfolio, you want names like this that are going to win quietly.
You mentioned this one earlier, Crombie REIT is one of your favorite plays in this space.
Yeah, grocery anchored retail, I think it fits into this theme of being defensive now. A very nice dividend. Last quarter, the same property net operating income was up nicely. Leasing spreads are doing well on 6.5% higher. Occupancy was up 40 basis points at 96.3%. Their balance sheet is pretty good. It's better than average. It trades at about a 16% discount to our net asset valuation for the name and at a reasonable 14.5 times price to AFFO 2023. So 14.5 times and growing at 10%, really, very, very attractive, paid very well to wait, very sensible on price to growth. And I think this fits in with this thesis of defense with some offense. So I think with all three of these names and Crombie, you're going to win quietly, getting that nice dividend and maybe getting another 5, 10, 15% capital appreciation.
Do you ever recommend non-dividend paying stocks to clients as a rule? Are you wary before you do that?
Listen, my mandate is North American equities. Shopify was one of my top picks, 2016. I'm not just dividends. People asking my growth and my value. I am just opportunistic. And wherever I see an idea that makes sense, where we can win without, with the risk reward looks really good, we'll go for it. So AutoCanada, not a dividend name really, or CAE are examples of that. So, we do have a bias towards dividends because it's great to get paid to wait. But, and I think you can win by just being a dividend investor. But I think that you can paint a much more illustrious painting by having all the tools, and that is non-dividend stocks as well.